homework problem, the bank reconciliation. And this is kind of the tricky part, was getting the deposits and the outstanding checks. And he should have gotten 5,200 for the deposits in transit and 5,700 for the outstanding checks. And once you get that, the rest of this isn't too bad. And I think this is what you should have gotten. And again, this is the tough part up here. The rest is kind of plugging it in. You know, it's kind of going the same spot. And you're going to have one of these on the test. Any question on that? Okay, well, tonight, finish the chapter 10 handout, cash, and finish monetary unit sampling. Well, this might be a little ambitious, but we'll give it a go. All right, one thing I want to show you guys that I didn't show you before, and I probably should have, and that is I sent out a this is a really old bank confirmation, but this is what a bank confirmation looks like. And a bank confirmation is different than a bank statement. I think you guys have seen bank statements. You have, you know, your checks and your deposits and withdrawals and blah, blah, blah. A big list of what went on in the account, what day it happened and all that kind of stuff. The bank confirmation is, as you can see here, is a very scaled down document. There's no transactions in it. None. And you say, well, why do we have it? Well, we have it because the big thing is it'll tell all of the loans that they have, what collateral they have, what the due dates, what the terms of the loans are, all that kind of stuff will be in here. It'll also have the accounts, you know, how much is in the accounts, whatever it, you know, whatever the ending balance is. You can get those off the bank statement. So the account stuff isn't necessarily that eye-opening, except that it may have accounts that the company's not showing on their books. So there could be accounts that they don't show, and they would show up in the bank confirmation. So the big thing for the bank confirmation is that it shows the loans and the percentages. And one of the things that you try to do is to, especially we get the interest rates that will be on the bank confirmation. You can then see if the interest rate that they're showing, you know, makes sense. You know, for example, if they're showing more interest than than you would calculate out that they owe on the loan, you know, let's say that you calculate out that they're going to pay off, you know, $4,000 of interest on this loan. You look at their interest expense and it's $7,000. That could be an indication that they have more liabilities, that there's some loan being hidden somewhere, but they're paying interest on it. So if they have more interest expense than you would think that they would have, given the interest rate they're paying, it could be that they're hiding liabilities. On the other hand, if the interest rate is lower than what you think that they should have, it could be that the owner is, say, giving a interest-free loan to the company. You know, that some of those loans are inflating the income of the company because they are interest-free. You know, for instance, if the owner is trying to sell a company or something like that, you want to make it look profitable, I'll give it an interest-free loan. can use the money and they don't have to pay any interest on it. So anyway, you know, the good thing about the bank confirmation is, again, that it tells all the specifics of the loan, what collateral is pledged, all that kind of stuff would be in there. Okay. And I'll try to get it an updated one. This is a 15-year-old Canadian one. It's one of those things that I can actually just make my own, is what I should do. But all right. So let's go back to the handout. Okay, so this is how we're going to use a cutoff bank statement. And we're going to kind of go through here and kind of figure out what is going on or where there may be problems. Okay, they're paid on the 28th day of each month. For some reason I got there. Oh, it's funded for exactly the payroll. Okay, so there's a control. So apparently the company has two accounts, and I think I talked about this before, maybe I didn't. Sometimes there's a control to have a separate payroll account. And that payroll account is if they make their payroll for $10,000, they'll fund the payroll account for exactly $10,000. It's a control to find out if there's someone either writing fictitious checks or changing their check to a higher amount. It'll show up as an overdraft in that bank statement, and that'll alert you to go look at it. So, you know, transferring money from one bank to another bank is a bank account is very common. And again, for things like payroll is a type of control. Saying the payroll should be 10,000. If more than 10,000 comes back, you know, is taken out of that account, then you know there's a problem. Okay. So these are the outstanding checks they showed on the payroll for the payroll account. Okay. So bank reconciliation, and these are the outstanding checks. Oops. There we go. Now we get a cutoff bank statement. And this was on the 8th. Okay, now, if you think about that bank reconciliation, those outstanding checks, most of those checks should have cleared by the 8th. You know, people get paid, they take it home, they go to their bank, they deposit it, and it should clear. It may not, you know, won't clear, maybe they don't all clear by the end of the month, but certainly by the 8th day, most of those at least will have cleared. So what we're going to do is we're going to go through and match up and see which ones of those cleared. Oh, you can't. How about now? Can you hear me? Okay. For some reason, my Zoom completely left.
Can you hear us now, Professor?
Yeah.
Okay.
Yeah, sorry about that, guys. I'm not sure what happened there. That was just completely unexpected. All right. I can't remember what I was talking about. Oh, I'm sorry, back to here. So the bank reconciliation, these checks that are on the bank reconciliation. Now, most of these, you guys can't see what I'm doing. The banks, the checks on this bank reconciliation, most of these should have cleared, right? You know, payroll check now. You guys hear me? Okay.
Yeah, I can hear you.
Okay. So the payroll check number, so these should mostly check. Now, maybe they won't all clear, but most of those should. So what we're going to do is go down here, these checks that cleared on the 8th, and see what, match them up with these for the bank reconciliation. Okay, so the first one here, yeah, I'm marking green. P1782, make sure the amount is correct. Okay. And so this one did clear. All right, P17895. CH10 okay. 18, this one cleared also. Okay, so it looks like everything except P17-1984 cleared. That's, you may look into that, but that may not be that big of a deal. There's always, there could be somebody who didn't cash their check for some reason or something like that. You may want to follow up on it to see what happened to that payroll check. Okay, so what things, looking at this, what things are unusual that as an auditor, when you look at this, you'd say, well, that's odd.
Those bottom 3 checks were written after the last one that was outstanding.
Yeah. These checks more than likely were written in December. And as you say, well, how do we know that they're not written in the beginning of January? That's another weird thing about this one. If these are payroll checks, why wouldn't they be written on January, say, 1st? Or they shouldn't be written on January 1st.
Employees are paid on the 28th day of the month, and they shouldn't, those last 3 checks just shouldn't exist.
Yeah. Now, we also, though, have another weird mystery here in this one. So it looks like this control of paying them on the 28th day of each month, it may not be really too much, as set in stone as we thought, because if this is written on the 14th. Now, the fact that these came in on January 2nd and January 3rd would be a strong indication that they were written in December. It's a fairly quick turnaround. So these may be expenses that belong in December. And even if they're paid in early January, the work that was done, you would assume, if they're paid on the 1st of the month, that would be a quite high one-day wages. That those probably relate to the previous, the December of 2021. So these 3 checks would probably be oh, that looks terrible. These 3 checks, let's leave it. So these 3 are probably relate to oops. probably relate to. Excuse me, sneeze. All right, so these, these last three checks probably relate to December, I should say, checks on the that's not how you spell the, by the way. All right, so the last three checks on the probably relate to it, but also there is the problem of, it looks like, according to their own records, that there was a check written on December 14th. That you have to look into it. And again, for all these, I mean, they're not necessarily proof of wrongdoing. You have to look into it. Maybe the check on the 14th was somebody quit on the 14th and they were given their check that day or something along those lines. But anyway, looking at this, you'd certainly have some questions. This one probably isn't that big a deal. It's probably just somebody that hasn't cashed it yet. But they won't all, they won't all be nice and neat. But anyway, certainly those last three checks and the check written on the 14th when they do payroll on the 28th is certainly something you want to look into. Any question on that? So this is what we do. This is why we get the cutoff bank statement. Okay. Bank transfers. Bank transfers, this is one of those things that's harder to do nowadays because so much is done electronically. But if they transfer from one bank to another, it's possible, if they're writing checks, to manipulate the cash to make it look higher than it really is. There also is a way to make it look lower, but we'll focus on making it higher, which is called kiting. Sorry about that. My allergies are kicking up. Okay. For example, I may have a separate payroll account. We just talked about that. As an internal control, the payroll account is only funded for the exact amount of payroll. So checks may take several days to clear the dispersing bank. If the transfer is made by check, the possibility of fraud exists. So notice what would happen. Now, this is only done if they're using two separate banks, which is why a lot of times banks require you to use do all your banking through them. If you use two separate banks, if you write a check and deposit it in the one bank, notice that's an outstanding check. It's going to be picked up as a deposit in the bank you deposited it in fairly early. But the bank that you wrote it off of may not disperse it for a few days. So notice the problem that you could have with that. You could have it look like magically money appearing in this bank account, right? It's a check, it's a deposit, and in a day or two or whatever it goes in, but it might take several days for it to be taken out of the other account. They're basically, you could use the idea of what they call check float to make it look like you have more cash than you really have. So this is what kiting is. You know, it's kind of like, you know, you're flying a kite over, you know, it looks like the same cash is in two places at the same time. You know, the person holding the kite is in one area, but the kite is over a different area. So it looks like, you know, it's in both sides. So kiting is oops. So kiting is using check float, the time it takes for a check to clear. Okay, now, if they are using a check and they're using two different bank accounts, there are a couple of rules that if they follow, then everything is okay. Oops. Okay, the journal entry must be made on the same date or before. The deposit is received by the receiving bank. So you either have to, when the deposit's made, it has to be at the same time or before. You have to make the journal entry that the deposit is being made. Yeah, again, you know, on the same date or before. 2. The journal entry for the deposit and the receipt must be made at the same time. Okay. So what we're going to do is kind of apply this, the criteria, those 2 criteria. It has to be done, the journal entry has to be done on the same date or before the deposit is made. So when you make that transfer, you have to have the journal entry made that same day or before. Okay, and then the second one is the disbursement and the receipt must be done at the same time. Okay. Oh, I did some right. So this first one, so the bank received it, Bank A received the deposit on the 31st. Okay, I tell you, I'm gonna make these different colors so that we can. Match them up. Okay, must be on the same date or before. Okay, so here's receiving date. And here's the journal entry date. So this first one for the criteria 1, is it okay or not okay?
Good.
It's good, right? Yeah, so the same date. Got it in there. The journal entry for the deposit and the receipt must be made at the same time. Okay, well, here's the deposit and here's the receipt. And it looks like they're made at the same time. So is there a problem with this bank transfer?
Nope.
So this is how you expect bank transfers to look. You know, the same date or before. You know, and notice here that when you do a bank transfer, your cash really isn't increasing or decreasing, right? Because you're just taking it from one account, putting it in another. So one account has 5,000 more, one account has 5,000 less. Okay. Is there a problem? No, there's not a problem. I'm going to copy these down to the other page here. Okay. So let's take a look at number 2. The receiving bank got this on January 2nd. The journal entry was made on January 31st. Is this okay or is this a problem?
That's fine.
Yeah, this is fine. The journal entry was made. So, and you know, maybe they made it on the 31st and maybe this is, you know, kind of like would be almost like a deposit in transit, that it doesn't hit the bank till the first. So as long as the journal entry is made on the same date or before, there's no problem. And it looks like these two were made at the same time. Both in the same journal entry. So this one is there a problem with this bank transfer? No. You know, in hindsight, I should make this so that it's. But we'll just go. Okay, number 3.
Yes,
Yes, there is a problem with this.
the journal entry was made after the date that it was received.
Good, yep. Yeah, so this one is a problem. Because notice what is gonna happen here. When they receive it on 12/31, there's no record of it in any, on the books. It's gonna look like $12,000 magically appeared in that bank account. So this would be, you know, why would they use this one? This would be one that maybe they have fictitious sales or something, whatever it is, that they need to cover, or if there was a theft or something from that account that they were trying to cover. That's how you would do it. You write the check, deposit it, wait until the next month, make the journal entry. In the current month, it would show up as a regular deposit, and you know that it would look like there's more money in there than there really is. So this is how you would make it look like you get more money than you really have. Okay, number 4. Number 4. I don't know if you can hear that, that's my crazy dog. Number 4 is the kind of the danger of splitting up the journal entry. You know, here's the journal entry for the receiving bank. And notice that these are not made on the same date. So they're split up, and this is part of the problem that you can run into. They pick up the one half of it as a revenue, and they change the other half to expense, but the expense notice is in the following year. So this would be a way of making it look like they have, well, first of all, it look like they have more cash because it'll say, you know, here's cash and that's a revenue. But also it's sort of like taking the income out of the following year, because now you're gonna go to the other side, which would be an expense. You could also put something else on the books on the other side, you know, asset or something like that. But so this would, oh wait, I didn't say why, did I? Oh, why? I'm sorry. This is back on the number 3. So the 12,000 would appear to be, so why? That's why. Number 4. And by the way, this is one that is, you know, can be a real danger because it'll show income as being higher. And also, unless you do something, unless you do a cutoff bank statement and figure out what they did with that, you know, when it was written and all that kind of stuff, matching them up. Notice it'd be very hard to argue against that. If you didn't know, if you couldn't match that up with the following, you know, with the cutoff in the following month showing that it really came from a different bank account of theirs, because they look, they say, look, it's cash. You know, we're not just putting this on the books and saying, you know, it's a sale and accounts receivable for some fictitious customer. They gave us cash, you know, that this will show up as cash, and that you know, it's very hard to argue with cash. Well, here's the cash, and you know, there's the revenue. Whereas if you can match it up, you can say, no, that cash came from this account, you know, that it was deposited in that account. So, you know, from a different owned account. Again, this is one of those things that I would say probably is pretty rare nowadays. It used to be more prevalent because it wasn't unusual to have different banks, and it wasn't, and people didn't do stuff electronically. Electronic transfers pretty much eliminate this because it goes from one account to the other account immediately, and they're both at the same time. And that's another reason why banks will oftentimes require that if they give somebody opens a bank accounts for a business, they'll say, okay, but we have to have all your business. You know, we don't want this Mickey Mouse going from one bank to another bank and all this kind of stuff. You have to have it all here. And then it becomes, you know, very obvious that it'll clear at the same time in the same bank, same, you know, between one account and the other. Okay, I think that's it for that handout, isn't it? Yay, okay. So that's the cash handout. And, you know, the cash, you know, just to kind of reiterate up here of why we do it is that it's because we can't audit it to the 100% level. That's why we're very serious about the cash. It's the most desirable one for people to steal. And while the cash account itself, a lot of times have a very small amount, virtually every single account is tied to it. You have to really think of a a strange transaction that doesn't go through cash at some point. So the reason why cash is such an important account and why we spend so much time on it, even though it's not a very big account monetarily, it is connected to everything. Okay, well, I think we'll start up then on the we'll do. Let's go to the monetary unit sampling. Got a little timer. It's a little too early to take a break. Let's go ahead and oops, what am I at? All right, I think we stopped here on number 5. We were doing the sampling, how you figure out the sampling and the incremental allowance, which we haven't talked about yet, but and the projected misstatement is 40,000 for this. Okay. Next two things we're going to do for this is basic precision and incremental allowance. And let me do something here. One of my world famous drawings. I was just playing with my ruler and I lost it. All right. So it's kind of like this. I gotta cheat and look back at the. Okay, they told us that the book value of this was $6 million. Did not notice that was in red. Fix that. Okay, so it's sort of like this. So if this was say 6 million, we were saying that our best estimate is that this is off by $40,000. The projected misstatement was 40,000. Okay, so this isn't to scale, by the way. Projected misstatement. So we're saying that this is, there's 40,000 that it could be, that is our best estimate. That what it could be off by. Okay, now here's the thing though. Because this is only for overstatements, it's still going to have a, what they call it, one tail. I made that kind of big on purpose. Because this could be off by more than just the 40,000, because it's a sample, right? It's a sample, so we're not 100% sure that it's 40,000. Because it's a sample, it could be off by more than that. And that's what we have to be careful about, because we have to see how much of this is, how much total could be out by. This is what's known as the upper limit. And there's two things that go into that. And the two things that go into that are basic precision and incremental allowance. Oops. Incremental allowance. So these are the two things that could go into that additional amounts. The first one is just because it is a sample. Even if there were no misstatements, you'd have basic precision. And this over here is for misstatements. Read that or not, but so misstatements are the. So these two things could add to it, and that'll give us the upper limit on misstatements. What could it possibly go wrong up to? So this is our best estimate. If someone asks you, what do you think it's off by? We'd say 40,000. But this is a sample. So it could be up by more than that. And the more misstatements we find, the more likely it would be off by more. So this is just because it's a sample, you're not taking 100%. And this one is that the amount of misstatements you find makes a difference. Okay, so that's kind of the, maybe it'll make more sense when we start going through it. Okay. Okay, so basic precision. So basic precision equals the interval times reliability factor. I'm going to copy that. I should probably copy this whole thing up there. That's what I'm going to do. Let me get this all closer. We're going to need it. Okay. Oopsie daisy. Gonna wipe it. Well, that'll be good. Okay, so basic precision equals the interval times reliability factor. Paste that in down here. Maybe make it not so big. Okay, so the interval that we can get from above. What's the interval for this one?
50,000.
Yep. So the interval, 50,000. Times the reliability factor. Now the reliability factor is, let's see, it's 5%. So you come up here. Row 0 is used for sample size and for basic precision. So here's row 0. At 5%, it is 3. Bless you.
Thank you.
Okay, so this is 3.0. So that equals 50,000, it was 150,000, right? So this is our basic precision. So going back to this thing, this basic precision says that this could be up to 150,000 more, just because it's a sample. So this is- The projected in this statement is this 40,000. But we're saying it could also be up by another 150,000 just because it's a sample. If you don't take 100%, it could be up by more. All right. Next thing we need to go to is the craziest thing we'll ever cover in this class. Incremental allowance. Overstatement 1 minus overstatement 2. And it's called the incremental allowance because it's the increments between the factors. In other words, the difference between them. So here comes the wacky. All right, so we come up here, and at 5%, these are the factors we're talking about. I'll copy this. I'll make a mess out of it if I do that. So we're going to take the increment between the reliability factor 4.75, that's for 1. Let me see here. And the incremental and the factor 3, we're going to subtract those 3 from the 4.75 and then subtract 1. That's really what I mean down here. So overstatement 1 is 4.75. Minus 3 minus 1 equals, I think it's 0.75.
Can you explain that again, Professor?
Yeah. If I ever write an auditing book, I'm just going to make a table of the incremental allowance. You take the reliability factors, the increment from 1 to the next, you subtract them, and then subtract 1 out of those. Subtract 1, which I'll be honest with you, I'm not 100% positive, but I think the 1 is probably a degree of freedom. But anyway, you're going to subtract 1 out of those, and what we're going to end up doing is multiplying this by the misstatements, because you'll notice that we actually have two misstatements. So these misstatements are going to get weighted, and so these misstatements are going to increase the likelihood that there's more misstated in this in our sample. If we didn't have any misstatements, we'd be done. This would be 40,000 plus 150,000 for the sampling, but because we have these two, and again, this incremental allowance is a wacky thing because it takes the increment from one reliability factor to the next and then subtracts out 1 for it, and that's just the formula. So I tell you what, let's go ahead and do, well, we'll do like 3 of these just for kicks. So the next one would have incremental. So you take overstatement 2 minus overstatement 1 minus 1. Okay, so the next one would look like this. $630 minus $475 minus 1. So 6. 0.55. Oops. So this is going to be the incremental, and I'll show you how we're going to use that in a second. We don't have a third overstatement, but I'm going to go ahead and do the third one just to bore everybody a little bit more. Okay, so this one would be, say, um, 7.76 minus 630. Yes, 0.46. So you'll notice something about these, the incremental allowances, is that they're getting lower. You know, 75. Okay, so here's how this works. So we got the increments here, reliability factor increments. Now you may be wondering why they just don't have a you know, you could easily make a table that just had the incremental allowances, you know, reliability factors and then incremental allowances. You could easily have a table that would have those. Why they don't do that, I'm not sure, but it certainly make, you know, there's certainly, you could certainly do this calculation. Let's put it into a table. Okay, so here's reliability factor increments. This third one we're not going to use. We don't actually have a third one, but if we did, you'd get the idea. And now we're going to take the misstatements, the largest ones first. So here's the misstatements. So the projected misstatements. Which one's the largest?
30,000.
30,000. So we're going to take the 30,000 first. So what we're going to do is multiply this And so we're gonna say, okay, because we have this misstatement, it's more likely that the whole thing will be misstated. So take say 0.75 times 30,000, which I think is 22,500. You want to check that?
You're right.
Okay, good. So this would be because of that first that first misstatement. This would be what we would have to add to it. And notice too, the larger the misstatement, the larger the likelihood that it's going to be off by more dollars, right? Oops. We go to the next largest one. And that was 10,000. So 10,000. Oops. $55 times 10,000 is 5,500. There is no third one, so we can just stop here and add these up. So there'll be incremental allowance for each one of these, so. Let me get rid of this one completely. Well, what is that? 28,000? Oops.
28.
Okay, so this would be the incremental allowance, 28,000. So this would look like. Like this. So this would be 28,000. So what we're gonna do is say the total that this could be misstated by, our best estimate is 40,000, but it could be off by another, 40,000 plus 50, 150 plus 28, whatever that comes out to. All right. Let's see here. Copy these down. Okay, so the total is 150, 218 maybe? $190, yeah, it's 218. So the upper limit on this thing would be 218,000. So going back to this thing. Now, what we're saying is the upper limit is And this is the number that we would use to see if it is, if we could accept the, if we could accept the amounts that they're giving us or not. We would use this upper limit, 218,000. Our best estimate is off by 40,000, but at the 5% level, we're saying that the upper limit is 218,000. And this is what we would see, if, you know, is this material? Well, that's a judgment call. Yeah. The $6 million account, it's up by 218,000. Whether that's material or not would be for someone else to figure out. But this would be the upper limit on the MUS statement. Wacky, huh? All right, now when we come back, we're gonna do another one. We'll do it all together. And this one's gonna be a little bit trickier. Or you can start on if you want. So let's say be back at what time is it? 7:03. We'll say be back at let's say 7:13 about. You can get started on it if you want. There's nothing wrong with that. This one's going to be the tricky one. I'll tell you that right up front. There's actually two tricky ones here. That one's tricky. This one's a little bit tricky. The other two are boring. Okay. Okay, let's go ahead and get started. Okay, the first one here. What is the projected misstatement? I'll give you a hint. You don't even have to. You don't even have to do any calculations. What's wrong with the first one?
Book value is smaller than the interval.
Yep. You'll notice that this is the other value is bigger. This is an understatement. Not a misstatement at all. Included? No, it's not. There's nothing wrong with it. Yeah, so this is an understatement. And this method is not supposed to find understatements. So when it does find an understatement, it says, oh, that's not what we're looking for. So you just ignore it, and you got to overcome that auditor instinct to say, wait, this is a mistake, but actually it's not in this method. Okay, second one is a kind of a normal. 15,000 divided by 20,000 times 10,000 equals our projected value for that, which is 75,000. I'm taking this understatement thing here out because that's confusing. Subjective misstatement is 25,000. So notice something here. You know, if we're saying that 75% of this interval, you know, is, you know, that only 75% of it is right, that there's this other 25% that is, you know, that it's a misstatement. Notice that that's going to go into our incremental allowance. So they say, look, there's 25,000 out there that could be worse than we think. And the fact that there is an error makes it, you know, more likely that there will be errors. Okay. What's the weird thing on this one?
It's bigger than the interval.
Yep. So this is bigger than the interval. This one has a 100% chance of being picked. It's going to cover one interval, maybe two. So now the rules for this one are a little bit wacky. What do we do with this one?
It's the actual misstatement.
Yep. So the actual misstatement. So that equals 108,000 minus 95,000. And that equals 13,000. So this is the actual misstatement, is 13,000. Oops, did it again. So this 13,000 now, notice that there, unlike this one up here, there could be other things left in this interval. We're saying this interval that this is only worth 100,000, there's 25,000 more that could be wrong. Notice in this one, there isn't. It covers the entire interval. So this one, while it is a misstatement, it is not going to be in the incremental. It couldn't get any worse. It covers the entire interval. And this last one here, it's gonna be a regular old. Oops. Oh, by the way, for this one, they'll tell you that for property, for monetary unit sampling, that if there's a zero account for an account, you should look in to see why it's zero, which to me is kind of silly because you do that for every account. Why, why is it zero? It's the whole point of doing the audit is you can see what the actual should be, and but anyway, sometimes you'll see that in textbooks, which you would do that for any kind of sampling if you came up with a zero account. Okay, so this one, the projected value is 0. Projected misstatement is the whole thing, was it 100,000? Is it an incremental allowance? Yes, it's an incremental allowance because the whole thing could have other errors in it. So the first one here is an understatement. We ignore it. This one, because it's bigger than the interval, we just take the actual misstatement. But it does not go in the incremental. And it doesn't go in the incremental because it could not get any worse. That interval is completely covered by the book value. All right, so these all together, 138,000, I think. Okay, I'm gonna shut up and see if you guys can figure out the basic precision. Now be careful because we're using 10% this time.
Is it 100,000 times 2.31?
Yep. So there's the copy from up here actually. So base precision equals the interval, which is 100,000. Times the reliability factor. I think I'm just going to use this one here. So we're at 10%. Oops. Yeah. 0, 2.31. And that equals 231,000. Yeah. And so this, again, the basic precision is when is even if there are no errors. So if there's no errors, the basic precision says, okay, well, this is still a sample. So it still could be off by some. You know, our best estimate is that it's off by 138,000. However, it could be off by more because, again, we're taking a sample. And the incremental allowances says, okay, well, if you have errors, then you're going to if you have errors that are for items that are less than the interval, there could be more things that are wrong. So, you know, that's when we'll take the incremental allowance. Now, how many incremental allowance factors do we need to calculate?
3.
Actually, just 2. These 2. So these, this and this one. I'll do it like this because this one's a no. It's not going to go in the incremental. Now, as long as you didn't put it in there, that's fine. So really, the 100,000 and the 25,000 are the only ones we're going to have. This one could not get any worse, so there's no incremental to that one. Whereas these 2, there's room for more things to go wrong. So coming up here, we're going to do the we 2. Okay, so we need 389 to 231. So 389, 231.
Minus 1?
Yep.
So that's going to be 0.58.
Okay. I forgot what I was doing. I'm going to write these down. How about? Go back to pen and paper, like the good old days. You know. Okay, so at 10%, we have the first one is 0.89 minus 2.31. So this will be for the first misstatement, minus 1. What'd you say it was 0.58?
Yeah.
Okay. So this will be the first incremental allowance that we'll have. And we need one more. And it's 533. What is it, 44? 0.44?
Yeah.
Okay. So 0.44. We could do a third one if we wanted to, but feeling particularly lazy. All right, so these are the increments. And again, this could easily be done on a table, set up a table for it. We don't need this third one. Okay, so the largest one would be what? Of the two we're gonna use.
100,000 and the 25.
Yep. So these are the two that we're using. These are the two yeses. So 100,000 would be the first one. $58,000.
Should be 58 and 11, I think.
Yeah, we have, so for 25,000. Yeah, you're right. Okay, so these are the incremental for each of the 58 for the first overstatement, 11,000 for the I don't know what to do like that. All right. 69,000. Okay, so all three of these together.
Should be 438.
Okay, good. 430,000. So this would be our, what we get to compare to see if to see if we would, you know, approve it. So the 430,000, how big is this thing anyways? The book value is 2 million, so this would probably be, I would have to think this would be material. You know, 438,000 out of 2 million, that's, you know, quite a bit. So it looked like this, if you know, to, oops, that's not correct camera. So this would be our estimate of what it was off by, would be 138,000. The second one, this is number 6. The basic precision was 231,000. And then because we had these errors, that could be off by another 69,000. You know, so all these together, our best estimate is this. This is the best estimate. But the upper limit says, okay, it could be off by as much as, you know, what it came out to, 438. Yeah, and again, this is 2 million, so I'd have to think at 438,000, quite a bit out of 2 million. I guess it depends on what the account is and how big the company is, but it seems kind of high. Okay. Okay, and we go over to some of the advantages and disadvantages, the comparison of the two for classical sampling. Monetary unit sampling, sometimes called dollar value sampling. The big one is smaller sample size. This is what really makes this appealing to a lot of auditors when they're doing an audit, is that sample size. It gets you through the audit quicker. It reduces the cost. You know, it really helps out if you can reduce the sample size. Now, it only works though if there's a lower occurrence of misstatements. So if the misstatements are a low occurrence, in other words, there's not too many of them, this way works out pretty well. Automatic stratification of the sample. I don't think we talked about that. Maybe we did. I don't think we did. Stratification of sample. We'll talk about this in the next sampling handout. It basically, stratification means you're more interested in larger dollar amounts, right? You're more interested in the $25,000 account rather than the $25 account. So bigger accounts you're more interested. This one automatically picks the bigger ones. You know, the bigger ones are more likely to be picked. And at some point, if they get big enough, they're 100% certain they'll be picked. So it automatically picks those larger numbers. That's kind of what stratification is about, is looking at the larger numbers that are more important rather than the little numbers that aren't. And it's generally easier to use in classical sampling. You may not think that right now, but in general, it's a much quicker type of sampling. And it's much quicker because you don't have to take, you don't have to have a preliminary standard deviation, you know, of the sample and all this kind of stuff that you have to do. The stuff you have to do to find sample size. And by the way, we didn't do that in classical sampling. I don't think it's ever been tested on the CPA exam. I could be wrong, but I don't think it's ever been tested on the CPA exam. And part of the reason why it's not tested is it's a very complex formula to expect people to memorize. So it's certainly not a lot easier. Disadvantages, and this is a huge one, is it cannot be used for understatements. And also, It cannot easily be expanded. In other words, if you have to take a bigger sample, it's harder to do with this one. You know, because here's what happens. You take a sample and you come up with some projected misstatement. Now, sampling in general, let's say you're sampling at the 5% level. That means 1 in 20 times you're going to be wrong. You can't get around that. That's you know, it's part of the drawback of using sampling is that a certain percent of the time you're going to be wrong, and if you're at the 5% level, that means 1 out of 20 times you're going to be wrong. So you come up with this sample, and it shows that the books are misstated. You don't go running and start accusing them of misstating the books. You say, okay, well, we better do some more work. You know, I want to make sure that these numbers are good numbers. If you expand the sample, it changes the interval. So expanding the sample size runs into a lot more problems because it's now going to impact which items you pick. So oftentimes when they run into these situations, they'll if they get a problem with the monetary unit sampling, they go to they fall back to classical sampling and use that as a way to reassure themselves of is a sample okay or is it not okay, that question. So it's not easily expanded because when you expand the items in the sample, all of a sudden you're picking different items because the interval changes. Okay. Classical sampling. Kind of the opposite of what you just have above. A few of the things here, it's okay with negative balances. Negative balances up here, well, you have to investigate them, but they tend to be a little bit trickier. The big thing about classical sampling is it can be used for anything. It can be used for understatements or overstatements. And so if you're not sure if you're looking at an overstatement or understatement, use classical sampling. It'll point you in the right direction, or should within the sample, the error of sampling. Sample size can be easily expanded. You can get more items, pick them randomly, and it will easily go in there, and you can get to a higher level of assurance about whether the sample is really accurately portrays the population as a whole. And estimating the standard deviation must be calculated. Get sample size. And stratification may be needed, which we'll talk about in the next handout. But stratification is, if you use it simply, if you take the sample, whatever is in the sample, and just take all the numbers randomly, which you can do, a lot of times you end up with, like I say, the $25 item is just as likely to be picked as a $25,000 item. Well, you don't really care about the $25 item. You do care about the $25,000 item, so you run into that problem of you have to break up, and you may have to do more than one sample. You have to do sample for items that are over $10,000, for example. The sample for items that are under 10,000 or whatever, however you want to do it. So sometimes it can be a little bit tricky in that regard. And this is very important. Back in my day, they would always kind of say, oh, the auditing, the monetary unit sampling is the best because it's made for auditing. But actually it is which one is more appropriate for the different circumstances. So there isn't the standards do not say which one is better than the other. It just says, one that are more appropriate than the other for using for to get an estimate of what the projected value and projected misstatement are. Question on that? Okay, so I think next week what I'll do is we'll do some multiple choice questions for chapter 10 handout. And I might I might review a little bit. I'll tell you which one. The kiting part is the one that gets missed the most on the test. So I think we might do a problem out of the book or something for that. And just to get more practice at it. We only did those last 4, and just to get more practice at it, I think maybe I'll pull a problem or 2 out of the book for the chapter 10. So for this week, you turn in the chapter 10 handout. Actually, let me write this in. Okay, so turn in the chapter 10 handout. And the monetary unit sampling handout. And those have a due date of Friday, 3/25. And those are, I think those are already in Blackboard. Let me check to make sure. Nope, not that. Yep. Okay, so next week we'll kind of, I just want to clean up a little bit chapter 10, and then we'll start in on chapter 11, which is accounts receivable. It's a much, all the chapters from here on out are much easier than the chapter 10 one. And we'll probably also start the last of the sampling handouts. Any questions on anything?
Nope.
Okay, well, I will see you guys next week. So if you want to turn in those 2, the monetary unit sampling and the chapter 10 handouts, there's a spot for those, and I will see you guys in a week's time.
Thank you, Professor.
Hey, guys.
Thank you.